Ladies and gentlemen, dear colleagues, dear organizers, thank you first for this opportunity to speak at this event. Although I know that the event itself is focused more on the industry side and on the industry provider side, or third-party providers to the industry, I'm really honored to be invited because I do believe that as of the 1st of January this year, we have formally entered a new era, i.e. called Solvency II era, which will, whether we like it or not, change our business life profoundly. And I know that you're all familiar with Solvency II, more or less, from your daily business, but just to set the scene, I would like to make some words of introduction of Solvency II just to make relevance for what I will say further. Foremost, Solvency II is a risk-based regime. What does it mean in really very general terms, a risk-based regime? As compared to Solvency I regime, capital requirements for the insurers reflect their riskiness. The old regime required insurers to calculate their capital requirements and also comply with them based on the past volumes of business, which might or might not have any relevance with their current or future exposure. The old system was very robust, which proved very well in the crisis of 2008 in the whole Europe. Basically, it was the calculation was so robust that it did not really needed any adjustments, but it did not really reflect the exposure a particular insurer was facing. In short, capital calculation bore no relation to actual riskiness of an insurer. Solvency II, as a risk-based regime, tries to capture actual risks an insurer is exposed to in a particular point of time. Furthermore, as Solvency I regime has been focused on only on insurance risks, whereas Solvency II is trying to capture all of the risks an insurer is facing. As the relevant, as if we are talking about the risk-based concept, there are a few new terms or old terms getting a new value in the field of insurance. First of all, we are talking about business model and business strategy. If we want to evaluate how risky a particular insurer is, we have to understand what is its business strategy. And where we are talking about business strategy, we are not talking about only nice words such as vision and mission, etc. We are talking about risk appetite. We are talking about the requirements of the shareholders, how much profit they do expect, how much value of their investment they are prepared to put at risk, etc. And basically, the insurers themselves and the supervisors, consequently, have to understand the risks they are facing and have to introduce them into the business model. And this will have a profound effect on the business they are conducting. Second concept, which is in principle familiar, but will get new dimensions in the Solvency II context, is the cost of capital or capital allocation. There will be no more cross-subsidizing between the different lines of business as to how costly a particular line of business is. The third concept, which has been until now more or less an accounting debate, but now it comes very much as a reality within the context of Solvency II, is about consistent market valuation of assets and liabilities. Basically what it says, it sounds very complicated, but basically we have to compare pears with pears and apples with apples. We have to be consistent and when evaluating our assets at market value, which is a problem all over the financial markets, and also at valuing our liabilities at market values, which means discounting the technical provisions, which is a particular issue because I have 20 years experience in insurance, both on the industry side and supervisory side, and we always tended to be used to prudent person principle in setting the technical provisions, and now we are basically getting to discounting technical provisions which are set at as exact level as possible. Just to finish this introduction, last year, which is basically an introduction to my thinking about what will change in property insurers with the introduction of Solvency II. Last year, I have been listening to Paul Sharma, formerly head of policy at FSA in UK, and I would say one of the fathers fathers of the idea of risk-based approach in insurance. And when he was asked what will be the most profound changes in the next couple of years on the insurance market, he says basically what will be offered to the insureds, to the clients of insurance companies, will be completely different, both on the industry side and on the consumer side. And this will be a result of three main factors. The first factor is the advances in technology, and basically this conference is about this issue. Second factor is the introduction of risk-based regimes all over the world, and if we're talking about European Union, about Solvency II, I will go more into depth a bit later about this. And the third factor is the introduction of new market conduct rules, i.e. rules relating to consumer protection. If I can just say a couple of words about technology, which, because of the subject of this conference, I think there are three most important fields how technology will affect insurance business models. I'm, of course, looking more from the supervisory perspective, but it also relates to business opportunities. The first factor is how technology will affect the lifestyle of average EU citizens, of consumers. Basically, all of the players will have to set their midterm and long-term strategies into changes of new lifestyles. Some risks will just disappear and some new risks will emerge. I had a discussion with a friend of mine who is an important player on the Austrian insurance market, and they are very much involved into motor business. And he told me that 10 to 15 years ago, 98 to 99% of all the youth between age of 18 and 20 passed the driving license. Basically, everybody wanted to drive a car. And now, I had this discussion last year, so in 2015, that the fact is that only 80% of the same age group passes the driving license. So if we, in 10 years, almost one-fifth of the population in a reasonably, in a developed Western European country, changes his lifestyle so that they do not believe that they will have a need of their own motor car, so that basically they will use other means of transportation. The risk is shifting from, I would say, traditional motor business to somewhere else. And the winner, of course, will be the one who will capture or locate where this shift is going. Because at the end of the day, the amount of risk within a society is remaining the same, or it's even higher. It's just shifting from one lifestyle to another lifestyle. And it's for the people who are dealing with the strategy within the insurance industry to identify where this shift is moving. Second impact of technology is about really the relationship between the customers, the clients, and the insurance company. I'm talking, of course, about segmentation. With the modern devices, we're talking about this all the time, but it's still very important. The insurers can really tie their products or their pricing into the life habits, or in insurance terms, to the risk of individual risks of a particular client. And this basically has, on one hand, of course, a good impact on the industry, because really the clients will really pay how risky they are. On the other hand, but on the other hand, it might have a negative impact, because we can come to a certain categories of clients who will not be insurable anymore. If we, for example, in motor insurance, if we take segmentation really far, if we have an 18-year-old male driver with a red sports car in a highly litigious environment like UK, you can come to the premiums which are 10,000 euros per year. And for an old lady with a car, with a car she's using once or twice per year, you can come to, I don't know, 20 euros per year. So it's basically when you approach really close to the client in terms of evaluating the risk, sooner or later we will come to the limit of insuredness, whether it's possible to insure or not, and we are really questioning as the supervisors what will come at this time. How will we insure the people who will just not be in position to insure themselves for their own, because of their own fault or just of the objective reasons. The third segment I would like to speak where technology will profoundly impact the insurance business is about the access of the industry towards the strata of population which has not been covered by insurance until now. I'm talking about the concept of microinsurance, which has been developed by the big players such as Allianz for the markets, for the low-income markets such as I know, Indonesia, South America, Jamaica, etc. But even if we are speaking about developed markets, I do believe there is a strata of population who can have real use and need of insurance cover, but it's just too expensive either for administrative purpose, because of the administrative problems, i.e. issuing the policies, etc., or because of the cost of intermediation, i.e. brokers and agents, to reach them with a reasonable price. And I do believe that with the modern technology, with mobile phones, etc., there is a potential new market for low-income population, even in, I would say, developed countries within the European Union, who has not been covered for some particular risks, which can be covered with the aid of new technology, which will reduce the transaction costs of providing insurance cover. So now I will start with my formal part of the presentation. It will be basically my first thoughts about how the Solvency II will affect the property insurers. I have to say that most of the debate within European Union at the EIOPA level, at the European Commission level, is about the impact on life insurers or on the providers of long-term guarantees, either life or pensions. But I do believe that, although there will be the most changes, I do believe that the Solvency II will also affect profoundly the property insurance business model. So, basically, general observations, what is relevant for insurers within Solvency II environment. First of all, company size will affect the business model. The bigger the insurer, the more diversified the risks, the less risk concentration, the better it will be adaptable for requirements of Solvency II. Secondly, specifics of particular products will come very much to the fore. If in the former regime, the only relevant factor for calculation of capital requirement has been the amount of premium gathered, here it will be the riskiness of the product, and riskiness not only according to the underwriting risks, but also to the other aspects of risks. And the third important issue is attitude towards economic steering, which sounds very, very complicated, but basically it's about very active and flexible use of capital. If a certain product, if a certain line of business, if a certain business sub-model will be proven to be expensive in terms of capital requirement, the business will move to other areas which are not so expensive in terms of use of capital. So basically the diversification, i.e. most different products, most different business models, most different lines of business, and flexible product design, i.e. if you can move quickly from, let's say, a product which will not be very efficient in terms of capital to move to another area will be the key competitive advantages within the Solvency II regime. If you have any questions, please interrupt me. It's absolutely no problem. Because the solvency regime is really using really taking into account all of the risks, and most of the risks in the insurance companies, because they are really financial institutions, come also from the investment side, i.e. from the asset side. The development of products will be really closely tied to the investments. Basically, products with the high market risk exposure may have to be redesigned or replaced. Unfortunately, here I will just speak. I will speak about long-term products, which do not affect you, but just to give you to give you a picture. There is a debate in my country, but it's very relevant also, for example, for German market, where there are really a lot of long-term contracts about whether within the Solvency II regime, the long-term guarantees will become so expensive that we are asking ourselves if such guarantees are really good for consumers. Isn't it better to have unit-linked products where you would really enhance competition and have proper disclosures? Secondly, new products will have to balance capital needs and clients' demands. And this will result in a shift towards less capital-intense products. I mentioned this already. And thirdly, changes in asset allocation will be due to the connection between asset liability management and Solvency II requirements. When we are talking who will be the winner on the market, we are of course talking about competitiveness. Insurance market in European Union is a very competitive market. We know all that, and that's basically why most of you are probably here. And increased pressure will be on smaller, less diversified players, i.e., for example, monoliners. They will have higher exposure to the risk of concentration, and therefore, which might result in higher capital requirements. Again, if you will be a big insurer with a diversified portfolio, you will, if you are really big, of course, you can devise your own internal model. But even if you are making a use of standard formula, you can optimize if you avoid the risk of concentration. Higher capital requirements and transparency on profitability may drive consolidation and increase in reinsurance demand. Basically, what will happen if the business model, because of some of the players, will not be competitive anymore, they will try to transfer the risk to the reinsurers, because of course, as all of you know, this will reduce the capital requirements because of the reduced risk. We will see, or we expect to see, some consolidation in terms of mergers and acquisitions on the market. Another feature which is also related to the saying big is beautiful is the high cost of compliance and rising barriers to the entry. We have to say that Solvency II regime is expensive. It's much too soon to say whether this expense is really worth the higher level of protection to the consumers. I believe nobody is in position to say this. And it really depends on the implementation and what will come out of the whole project after a couple of years. But now what we can say, it's expensive, and it poses, because of the price, a high barrier to entry. The important issue is that risk management, from the very high level corporate view to the lowest level underwriting or claims management view, will be awarded in terms of less capital requirements, and therefore the more efficient, less risky, or better risk managed companies will have a competitive advantage over the other ones. Solvency II is also very much about transparency. There will be a unified reporting on EU level, which will increase comparability between markets, business models, and companies. Since the early 90s, sorry. Technically, we have one single market in insurance, but there is really very little cross-border insurance operations. There are some cases, for example, between UK and Ireland and so on, but most of the markets we see very little cross-border operations. So we cannot really. And one thing is the nature of insurance, because the clients tend to be conservative while changing the insurers. The other issue is that there has not been really a level playing field. And the unified reporting and transparency solvency, the higher level of transparency Solvency II is bringing, will be also a function of leveling the playing field and more competition for the citizens of European Union. Management of companies will experience a paradigm shift towards economic valuation. It's very important that the results of the companies for investors and other stakeholders will be basically done on the same level for everybody, and which will be also basis for calculating the riskness, which will result in the capital requirement, which ultimately will be borne in the price of the clients. There will be an increased interaction with supervisors. We see this already. I mean, before the insurance supervision was a box-ticking exercise. We just went to an insurer and we just saw if it's compliant with law. Now we will have to understand the business model, and the insurers will have to understand what are our expectations. So there will be an increased interaction or dialogue between supervisors and the industry. And there will be enhanced disclosures which will ensure better consumer protection. This is basically the result of three major shifts. One is already in Solvency II, which is in the part of system of governance. Basically, within all the other risk management issues, the boards of the insurance companies will also have to be transparent and fair to the consumers. Secondly is the EIOPA's guidelines on product oversight and governance, which are bringing even additional rules in this respect. And thirdly, it's the implementation of IDD directive, which has already been adopted, but will have to be introduced into the local legal systems at the beginning of 2018. So, about the impact on products themselves. As already mentioned, but it's very important to get this message through, Solvency II will give incentive to diversify insurance portfolios, and will have an incentive to get from the long-term effect, from the portfolios which have long-term effects. General impact on products. If you're talking about Solvency I, which did not set any incentive for risk-based pricing. Basically, you had a volume of premium and you calculated your capital requirement at a certain percentage of the volume of premium in previous year. Solvency II will lead to alignment of pricing, risk, and capital management. So there will always be a balance, will have to be a balance between the triangle of pricing management, risk management, and capital management. And the design and pricing of the new product will take into account risks versus profit for the insurer. The impact on products. Product design can make a product more or less attractive to potential policyholders, more or less risky to the insurer. This will be the result, and this will be the trade-off. If the risk will be transferred to the reinsurance markets, this of course implies a cost for the cedent. If capital, in respect of capital allocation, this implies the cost to the shareholders, i.e. what will be the expected returns for the shareholders. And key question, how can new products be designed to achieve the same profitability as traditional products? Very probably, in very few cases, this is achievable. Again, impact on products, importance of risk management by product design increases. Again, risk managed companies in all of its processes, and here we are talking about especially on the process of the product design, will be awarded. Optimization possibilities, of course, is that the same profit for the insurer, same results for the policyholder, same profit and the same risk for the insurer, same profit and low risk for the insurer. And basically what we come back to what I said in my introduction, that the capital adequacy or the capital requirement will depend on the business model. And here again we are coming that both the insurers themselves will have to understand the business model they are running and the risks and the risk appetite they are running, and we as the supervisors will have to understand the business model we are supervising. Other effects of Solvency II on profitability is investment income in the low interest rate environment which we are living now, and we don't know how long it will remain. Basically, there will be less possibility to cover the underwriting losses with investment income. This has a twofold effect. Here I'm just mentioning one, which is the dangerous one, that the insurers will try to to fill this gap with riskier investments. On the other hand, of course, as an underwriter in my former life, I can also say that basically the insurers have to go back to the traditional underwriting methods and understand the risk they are underwriting. Of course, it will come also to the optimization of the investment portfolios and taking into consideration the risk profile and the insurance liabilities as such. There will be, as already mentioned, a profound impact on competitiveness. Of course, there will be increased transparency of the viability of the business model. And when I'm talking about the business model, not only a business model of the whole company, but also by lines of business. There will be no cross-subsidizing, and this is important. There is a clear competitive advantage for better diversified insurers, very probably larger insurers, and the insurers with good risk and capital management. Better risk and capital management will also influence the competitiveness of, in product design and pricing. Basically, the better run companies will be more competitive because the regime encourages better risk management. And just very briefly to conclude, I do believe there will be more competition. Size will count, diversification will count, and the aim is, and I believe it is achievable, although all of us will have to be very careful about it, is that the insurers will be less riskier, so basically they will be in position to fulfill their promises arising out of their business, and based on the risk-based competition, consumers will pay the prices which will more reflect the risks they are running.